Today, we're talking about the real estate side of my portfolio, specifically 3 positions I currently hold: Realty Income, ticker symbol O, IYRI Realty, ticker symbol ADC, and the NEOS Real Estate High Income ETF, ticker symbol IYRI. We'll review their performance over the last year, walk through the pros and cons of each, and look at where REITs could go depending on what the Fed decides to do with interest rates later this year. I'll lay out the data and some possible scenarios so you can decide for yourself what makes sense for your own strategies. Make sure you stay till the end though to see how much of my portfolio I have allocated to each of these holdings. So let's get into it. Welcome back everyone. Let's get into my REIT breakdown. As always, if you have questions, drop them in the comments below. This isn't investing advice. This is just what I'm doing, so please always do your own research before following anyone on YouTube. Okay, let's start with Realty Income, often called the monthly dividend company. They have a simple ticker symbol. It is O. And not many people know this, but the O in the ticker symbol is meant to represent opportunities for investors to benefit from their investments through monthly dividend payments. And now you know, knowing is half the battle. Moving on to stats. So the current price of Realty Income as of the date of this recording is $57.44. The year-to-date performance so far, it's up 7.55%. And the dividend yield is currently at 5.62%, and that's about $3.23 annually per share. And for me, my cost basis is about $57.20. And my cost basis is that because I only added it back more recently. I know that I got out of at a good time because the price when I sold was around $65 back in 2023. Now, Realty Income has been an industry leader for decades and over 30 years of strong results. They've paid and grown their dividend through multiple recessions, market crashes, and even the pandemic without a single cut. And this is probably the biggest reason I like O. So that 30 years, they haven't had a dividend cut. They've increased their dividend every year for 30 years. Insane. Their portfolio is massive and diversified. It's across industries, geographies, and the tenant types, they make them one of the most stable names in the REIT space. Think of the Encore and Bellagio resorts in Las Vegas. Think Lifetime Athletic, Lowe's hardware store, and maybe even your local grocery store. They have some giant names as tenants. And even with all of that, I actually stepped away from this REIT for a while to go heavier in our next REIT. But it was hard to stay gone. The resilience of O, the big names, and the steady growth record make them a core holding for many income investors. And for me, they're back in my portfolio as a reliable long-term real estate anchor. Now comment down below if you hold O or if you got out of it for whatever reason. I'd love to hear how you see and think about Realty Income. Now, let's talk about who I moved to a few years ago and basically took all of my Realty Income shares and converted them to IYRI Realty Corporation, ticker symbol ADC. So the current price for ADC is $73.32. The year-to-date performance so far is they're up 4.07% with a current dividend yield of about 4.19%. And that means about $3.07 annually per share. That's what they pay out. And the cost basis for me is about $71.64. IYRI Realty is just as solid as Realty Income, if not more in my perspective. They've grown their dividend for 4 consecutive years with a 5-year dividend growth rate of 6% per year and a 10-year rate of 5.9% growth for their dividend. Their portfolio is one of my favorites in the REIT space, with tenants like Walmart, Costco, Home Depot, Target, and sure, some of these retailers, they've faced headwinds lately, but they're industry leaders that aren't going anywhere anytime soon. I don't see Costco closing a warehouse anytime soon. If anything, they're opening up more. And they own and operate 2,513 properties across all 50 states with 68% investment grade in tenants and 52 million square feet of gross leasable area. Combine that with the consistent year-over-year revenue growth, and there you have a REIT that continues to deliver stability and income and shows you why I like ADC so much. And finally, let's talk about the NEOS Real Estate High Income ETF, ticker symbol IYRI. And if you've been following me, you know I'm a fan of NEOS, and this ETF performs just like the others. If you don't know NEOS, it stands for Next Evolution Options Strategies. And we'll get into what that means and looks like later on in the video. So with that, let's get into the stats for IYRI. So the current price, $49.87 as of the date of the recording. Year-to-date performance is actually down 1.05%. And the dividend yield is at 11.31% and pays out $5.64 annually per share. And my cost basis is about $49.96. Not too bad, but this is definitely one I'll be monitoring, especially with the Fed decisions on rates each month, but we'll get into that later. But here is why I own it. So I used to hold a lot more REITs, equity REITs, M-REITs, all sorts of subcategories. Think of things like FRT, AGNC, Vici, Analyte Capital, and even more. And it got way too complicated to manage, especially since I also own physical real estate. So I decided to simplify my portfolio and then consolidate most of my REIT exposure into this one fund along with ADC and O. Now I'm a big fan of NEOS, and this ETF keeps things simple for me while still providing a high distribution yield. And that matters because I like to keep my portfolio efficient and flexible, especially since I experiment with a variety of funds and I partially live off of my distributions. So this is off their website that IYRI's investment objective is the fund seeks to generate high monthly income with the potential for equity appreciation. Distributions may come from option premiums, dividends, capital gains, and interest payments, and a portion may be classified as return of capital, which can have potential tax advantages, which a lot of people, it's controversial whether you like return of capital or not. I'm a fan because of the tax advantages and delaying capital gains. So this is off of their website too, and this is the strategy. 1, distributes high level of monthly income through data-driven call option strategies on ETFs tracking the Dow Jones US Real Estate Capped Index. 2, actively manage to balance income generation with upside potential. And then 3, offers efficient exposure to US listed REITs with an enhanced layer of income potential, all in a single ETF, which I love. Talk about simplicity, makes it really easy. So for me, it's a one-stop shop for broad REIT exposure plus strong yield without all the complexity of managing a dozen different real estate positions like I was doing before. This is just way easier. Yeah, I'm down 1% for the year, but that has more to do with the overall market than just this stock. So that is a rundown of what I have in the taxable account I use to live off of. Here's how these fit into my portfolio and my percentages of positions. So O is my steady, time-tested performer. It's a steady Eddie, and it currently makes up 0.57% of my portfolio. It's a small amount, but it will continue to grow. ADC is my quality tenant growth focused REIT. This is also my largest REIT holding, which is around 2.47% of my overall portfolio, and that will probably grow too. And then IYRI is my high yield simplified real estate income play. And this makes up a really small 0.41% of my portfolio. But to be honest, I've just started my IYRI position and it's likely going to be closer to 5% by the end of the year, depending on what happens with the Fed rates, which we'll get into next. With these holdings, they each have different strengths, but together they gave me diversification, stability, and income, all without making things overly complicated in my portfolio. Like I said, I like simplicity best. Now, this breakdown would not be complete without me talking about what things can impact this part of my portfolio. And a big thing that I'm keeping my eye on is the Fed and what they're going to do next. So REIT performance is super closely tied to interest rates, and the Fed's next move could impact that sector a ton. So definitely worth keeping an eye on. So if the Fed cuts rates by the end of the year, here's what could happen and what I would be watching for. And we'll be watching for. So first off, borrowing costs for REITs would drop. And this would greatly improve profitability for a lot of the REITs that are out there. Lower bond yields would make REIT dividends more attractive to investors. Lenders may loosen credit requirements, making it easier for businesses and individuals to borrow. Interest rates are like at 7%. It's insane. And with that could help unlock some of the frozen real estate markets. We'd likely see less of the buyer-seller standoffs we've been seeing across the states more recently. You'd also see lower mortgage rates, and that could stabilize home prices or even push them higher as more buyers re-enter the market because of affordability. And in terms of the stocks for these REITs, we should see them start to recover or climb in this scenario if the Fed drops the rates. Now, if the Fed holds rates steady, or in the unlikely event that they raise them, here's what I'm looking for and what potentially could happen. So, borrowing stays expensive, and this would keep pressure on REITs and their margins to maintain their profits and could mean less expansion and optimizing their existing portfolios. Buyer-seller stalemates in housing could continue to go on. We'd see fewer transactions and continued low inventory from sellers and builders. In some markets, sellers who need to move could be forced to drop their prices, which would bring the values down in those particular areas, which could be good for buyers, but bad for sellers and homeowners. And then for REITs, this scenario might mean stable dividend payouts, but slower share price appreciation or even declines. And for me, that means many of these stocks would be on sale, and it could be a great buying opportunity. Always looking for the silver lining. What is the upside in each scenario? This is why rate policy matters so much to real estate. It doesn't just affect big commercial REITs. It ripples down all the way down to residential markets, you and me, and then lending activities just across the board. So, what do you think? Are you bullish or bearish on real estate and REITs right now? And what's your bet? A rate cut this year or no movement from the Fed? Drop your thoughts in the comments. I'd love to keep this conversation going. And if you haven't by now, I'd really appreciate a like and subscribe so you can help me grow the channel and help me continue to make content just like this. Remember, if it doesn't challenge you, it doesn't change you. Messy action is better than no action. Take care. I'll see you next time. Boom.